All right, let's get straight to it. We're talking about money, your money, and a little three-digit number that packs a mighty punch in Canada. This number is your credit score. Think of it as your financial reputation all summed up. It tells lenders and sometimes even potential landlords or employers how well you handle your financial responsibilities. Ignoring this score is like trying to navigate a maze blindfolded. You're almost guaranteed to stumble. So listen up, because understanding your credit score is the first step to taking control of your financial future. This score isn't static, it breathes with your financial life. It goes up when you manage your credit wisely. It dips when you make missteps. Lenders use it to decide if you're a good risk or a bad one. Will you pay back what you borrow? Your credit score gives them a pretty good idea. A good score can open doors, while a poor one can slam them shut right in your face. It's that simple and that serious. Many people float through life blissfully unaware of their credit score's power. Knowledge is power, especially when it comes to your finances. This guide is here to help you do just that, plain and simple. So what exactly is this credit score we're talking about? In Canada, it's typically a three-digit number that ranges from 300 to 900. The higher the number, the better your credit worthiness is perceived to be. Think of it like grades in school. A score in the 800s is like getting an A+. You're a star student in the world of credit. Scores in the 700s are still very good, like a solid B. Once you dip into the 600s, lenders start to get a bit more cautious. Below 600, and you might find it tough to get approved for new credit, or you'll face much higher interest rates. This score is derived from the information in your credit report. Your credit report is a detailed history of how you've used credit over the years. It lists your credit accounts, like credit cards, loans, and lines of credit. It shows how much you owe and whether you've made your payments on time. Knowing your score and what it means is like having a map for your financial journey. Now let's peek into the kitchen and see what ingredients go into your credit score. The most important factor by far is your payment history. This accounts for a big chunk of your score, around 35%. Are you paying your bills on time every time, or are you frequently late? Every missed payment can leave a nasty stain on your credit report and drag your score down. Lenders want to see a consistent track record of responsible payments. The next big ingredient is your credit utilization. This refers to how much of your available credit you're actually using, especially on revolving credit like credit cards and lines of credit. This typically makes up about 30% of your score. Aim to keep your utilization below 30% on each credit product. Lower is always better. Then there's the length of your credit history, which contributes about 15% to your score. Generally, the longer you've had credit accounts open and managed them well, the better it is for your score. The final ingredients are new credit inquiries and your credit mix, each accounting for about 10% of your score. It shows you can manage various forms of credit responsibly. In Canada, there are two main private companies that act as the primary scorekeepers of your credit information. These are Equifax Canada and TransUnion Canada. Think of them as the official record keepers of your borrowing and repayment habits. Lenders, like banks and credit card companies, report your account activity to these bureaus, usually on a monthly basis. This information forms the basis of your credit report. These two bureaus operate independently. Knowing who these scorekeepers are and what they do is fundamental to understanding how your credit is managed and reported in Canada. Section 5. Why your credit history is your financial passport. Think of your credit history and the score that comes with it as your financial passport. It can grant you access to all sorts of financial products and opportunities, or it can restrict your movement significantly. A strong credit history doesn't just mean you can borrow money more easily, it often means you can borrow it on much better terms. This translates directly into saving money. Beyond just loans and interest rates, your credit history can influence other areas of your life. Many landlords now run credit checks as part of their tenant screening process. Similarly, some employers, especially for positions involving financial responsibility or access to sensitive information, may request to see your credit report as part of the hiring process. Ultimately, a good credit history gives you options and financial flexibility. Section 6, the ripple effect, credit scores, loans, and your wallet. The connection between your credit score and your ability to get loans is direct and undeniable. Lenders are in the business of managing risk. When you apply for a loan, they want to know how likely you are to pay it back as agreed. Your credit score is one of their primary tools for assessing this risk. A high score suggests you're a low-risk borrower, making lenders more willing to approve your application. Conversely, a low score signals higher risk, which can lead to loan denials or much stricter lending conditions if you're approved at all. But it's not just about getting approved, it's about the cost of borrowing. Your credit score significantly impacts the interest rate you'll be offered. Borrowers with excellent credit scores typically qualify for the lowest advertised interest rates. This means your monthly payments will be lower, and the total amount of interest you pay over the life of the loan will be substantially less. For example, on a mortgage, even a 0.5% difference in the interest rate can save you tens of thousands of dollars over a 25-year amortization period. Credit card companies also use your credit score to determine your credit limit and the interest rate on your card. A good score can lead to higher limits and access to premium cards with better rewards. Nurturing a healthy credit score isn't just a good idea. It's a financially savvy strategy that saves you money in the long run. Section 7. Sprucing up your score. Tips for a healthy credit profile. If your credit score isn't where you'd like it to be, don't despair. There are concrete steps you can take to improve it. The most crucial action is to make all your payments on time, every single time. Payment history is the heavyweight champion of credit score factors. Set up automatic payments or reminders for all your bills, including credit cards, loans, utilities, and even your cell phone bill if it's reported. Even one late payment can have a negative impact, and multiple late payments can seriously damage your score. Consistency is absolutely key here. Next, focus on your credit utilization ratio. This means keeping the balances on your credit cards and lines of credit low relative to their limits. Aim to use no more than 30% of your available credit on each account, and ideally even less. If you have high balances, work on paying them down as aggressively as possible. Be mindful of opening too many new credit accounts in a short period. Only apply for new credit when you genuinely need it and are confident you can manage it responsibly. Section 8. Staying on top, monitoring your credit health. Building a good credit score is one thing. Maintaining it and protecting it is an ongoing task. That's why regularly monitoring your credit health is so important. You are entitled to receive a free copy of your credit report from both Equifax and TransUnion by mail at least once per year. Take advantage of this. Make it an annual ritual like a financial checkup. When you get your reports, review them carefully line by line. Look for any errors, inaccuracies, or accounts you don't recognize. Mistakes can happen, and they could be unfairly dragging down your score. If you do find an error on your credit report, don't panic. Both Equifax and TransUnion have processes in place for disputing inaccuracies. Correcting errors can sometimes lead to a significant improvement in your credit score, so it's well worth the effort. Section 9. Your credit score, your key to financial freedom. So there you have it. Your credit score is much more than just a number. It's a powerful tool that can significantly shape your financial life in Canada. It reflects your past financial behavior and influences your future opportunities. From getting a mortgage for your dream home to securing a loan for a new car, or even just getting a decent interest rate on a credit card, your credit score plays a pivotal role. Understanding how it works, what affects it, and how to manage it effectively is not just smart. It's essential for your financial well-being. Taking control of your credit score means taking control of your financial options. A healthy score can save you substantial amounts of money in interest payments over your lifetime. It can open doors to better financial products and services. It can provide you with a safety net and greater flexibility when unexpected expenses arise. Don't let your credit score control you. You need to be the one in the driver's seat, actively managing it. Your journey to mastering your Canadian credit score starts with knowledge and continues with consistent, responsible action. So go ahead, take charge, and unlock the financial freedom that a good credit score can help you achieve.